Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hello, everybody. Welcome to Vantage Point with True North Wealth Partners. Eric Susie here. Today is Tuesday, April 18th. It is tax day, so I'm sure you get your taxes in. I have to drop mine off by 5 o'clock today, so it gets in the mail, so the government's happy. I hope you're doing well. Again, it's Tuesday, episode number 33. So, and 33 was an old football jersey from Tony Dorsett, Dallas Cowboys. So there you go. Anyways, I hope you're doing great. Happy springtime. Hope Easter and Passover and all that was all good with you and your family. So I'm flying solo today. So unfortunately, Andy's a little bit under the weather. Eric is out of the office, and Russ is up north in Worcester. So I'll be going through things. I do want to point out we do have a new advisor under our wing here. Joined us earlier this year. Jim Piccolo. So Jim Piccolo, and I'll bring him on. Andy and I will have him on so you can see the latest advisor here within the True North family. So great guy. It's a short little story. Didn't know this, but his wife actually went to school with my sister, Denise, who passed away, but back at Watterson, clear back in the 80s. So it's a small world and how things all come about. But a great guy. You'll enjoy him. So let's get into it. There is a lot. So I'll do my best to educate and convey what's going on in the markets as best I can. So, high frequency tracker data, we get this from First Trust, but some good sprouts, shoots are still up there. Initial jobless claims are still relatively low, and the jobs are hanging in there, I guess is what I'm trying to say. Box office receipts have still relatively high. Hotel occupancy is high. TSA checkpoints as far as flights is still relatively high, so that's all looking pretty good. Some on the downside of things, steel production, it is the lowest since 2020. So steel production is definitely on the low end. Other things, I mentioned this back in January, the ASA staffing index. So that's a leading indicator for the economy. So that is turned over and going lower. So again, that is not as high and weakening. So that's something that we'll continue to watch because companies, instead of necessarily firing folks, they first stop the ASA staffing first, and then they get onto the firing aspect, which they've done all year long, unfortunately. Weekly retail sales is also soft as well. So sales are coming down too. So I just wanted to point out some overall high themes of what's going on. Trading volume is interesting. So this year in general, it has been interesting. So trading volume, just some stats for those of you that know, I track trading volume daily basis. So the average, like yesterday's trading volume was a little more than 3.28 billion trades. So 3.28 billion trades was a trading volume for yesterday. That's the total trading volume on the New York Stock Exchange. So with that being said, relative to what? So the average year to date is averaging 4.2 billion trades. So 4.2 versus 3.328 yesterday. So you can see it's light. So we're hitting again near these highs, heading into earnings. So that's a canary in the coal mine. So I've done this, tracked it, learned all this back in T. Rowe Price days in the late 1990s. So expect more volatility to pick up. 4.2 billion is the average trading volume for this year to date. What's that compared to? Last year, 2022, the trading volume was 4.6 billion trades. So 4.2 is this year to date. Last year, average 4.6. We're down 8.8% in trading volume. So I find that interesting. And, it's not necessarily good when you're hitting, markets are melting up prior to all the earnings that are being released here. First quarter earnings are out. Started with the big banks last Friday. There's 4 big banks typically, pretty much carrying the financial markets for now on the financial side. The mid banks, the regional banks are getting hammered, but you still need the regional banks. Fear Greed Index. That's just one of the many things I follow. So that hit 70 yesterday. Okay. The highest year to date was 77 back on 2/2. So fear greed 77. You want to sell when when it pegs like close to 100. You want to buy when it gets down to 0 or 1. So right now, as of yesterday, it was hit a 70. So those are just things that you have to keep in mind as far as where we are in the cycle. So the markets are still in a quad 4 economic cycle-wise. So for those of you, remember the quads, these are by Hedgeye, that one of our research partners that we use. Quads 1, 2, 3, 4, spring, summer, fall, winter. So we're in the winter quad 4. So have been fourth quarter, first quarter of this year. Second quarter it will be so as well. Then hopefully things lighten and get a little bit better, moving up. It's a coin flip as far as where it goes to. Could be a quad 1. It's all relatively on the 4 quads are all in the 30 percentile range moving around. So it's a coin flip to where it moves to the back half of the year. So that's why we talked about the tale of 2 halves early on. So keep things that in mind. There's going to be a lot more volatility. The VIX hit yesterday below 17. So that's the lowest year to date. So low trading volume, markets are hitting highs. VIX is low year to date. It doesn't set up for good news. So there's going to be a lot coming on these next, I'd say 3 months. So we'll get into some other aspects. Again, Jerry Siegel from Wisdom Tree, a part that came out, and his economics not falling apart yet. And the key words "yet" is what he said. That was his Monday economic indicator commentary back on 4/17, so yesterday. So things that are people are still worried about, etc. So some stats. GDP nowcast came out today from the Federal Reserve Bank of Atlanta. So this is hot off the press, April 18th. It's now 2.5%. So it was well over 3, 3.8, what have you, coming back down to 2.5. So they're coming in, where the Hedgeye GDP nowcast was negative. Now it's coming up positive. So just slightly above 0. So my point is it's all going to equal out to, let's just call it, maybe 0.5% when it all comes said and done, where the GDP for the first quarter of 2023. So that's that. And the things are, I don't want to be Debbie Downer, but it's just interesting following tracks and things. The Fed does control on the short end of the yield curve. So just as a reminder, you hear all the talking heads, and remember, please discount that. They're there to sell eyeballs. So they need viewership and ratings. So again, the 3-month, 6-month, 1 year, 2 year, that's the short end of the yield curve. The Fed controls that. I do anticipate them increasing rates next month, quarter basis point, like we said earlier on our podcast last month and a half ago. So I'm hoping it's the last one. We'll see. The Fed's Powell and the Fed, they have, we'll see if they're going to do any more than that. I hope not, but we'll see. So at least a 25 point for sure. The market controls the long end of the yield curve. That's the 3-year, 5-year, 10-year, and 30-year. There's actually a 20-year in there now as well. So again, markets control that. The 3-month T-bill yesterday crossed over 5%. So you can get for 3-month over 5% yield. That's incredible. So we'll talk more about that coming in a little bit later on models and things that I've done personally for my clients affected. In addition, just talking about money flow. So change in money market rates. This is all coming from First Trust. This is coming from the week ending April 17th. So institutional change in money market rate assets. So the flow of people putting money into the institutional and the money markets funds, $22 billion was last week. That's $22.17 billion to be exact. The week before that was $27.09 billion inflows into money markets. So institutionals are playing it a little bit safer, putting money back into. So the setup doesn't look too good as far as near term, and that's why we still we all have a defensive posture to their overall models. Interesting too. That's tale two halves. As far as last year, the asset classes that got hammered last year are doing good this year. So the QQQs, there's I think 7 companies that are basically represent around 90% of the growth in the NASDAQ. So that's interesting. And then the large company growth. This is from White Charts. It's a heat map chart. So White Charts, one of our preferred sources as well for our research. Last month, quarter to date, first quarter, large company growth was net outflows was 19.17 billion. 19.17 billion in net outflows occurred year to date. But however, large cap growth was up 9.81% for the first quarter. So most folks pulled money out, even though it was the best asset class. So it's just interesting, the dynamics of certain asset classes that have done well and not done well. Small caps still not doing well. International has finally come off the floor from last year, and international is doing a little bit better as well. So with that being said, I guess this is more, again, on my clientele. So I'll just speak to that briefly since there's no one here handy to go through this. I in my middle rebalance as well. So by the time you get this, it gets publicized, Thursday, Friday this week, after it goes through compliance check and all that, you'll see in your portfolio the new revised models updated. Basically, I'm still in a conservative tilt, but I did, now that you can make money in bonds again and actually treasuries. So we're using treasuries. So the 3-month, you'll see that, the 6-month, 12-month, and the 2-year. So going a little bit longer on duration. So you'll see those within your portfolio just because, like I said, the Fed is pretty much getting near the top of one more rate increase. That's already priced into the markets. So the markets do anticipate 70% chance of 25 basis points. So it's priced in. What's interesting though, and this is a huge disconnect, and the markets are going to be set up for disappointment, I believe, is the markets are already pricing in 4 rate cuts after May. So I don't see that happening. The Fed's going to raise next month, 1/4 point, and they're going to hold. I hope they hold, and that's it. No more rate increases. They're going to hold pretty much for the end of the year, okay? If they do cut, it won't be till November or December at the earliest. So we've been saying that consistently. So the markets are already pricing in 4 1/4 point rate cuts starting June, July. So I think that's going to be a rude disconnect and awakening. Also, the debt ceiling, there's going to be a lot of banner going on between all that. So we're not more market volatility will continue to go higher. So models, my clients, yes, you've seen this before. These are the models 1 through 5. 1's conservative, 5's aggressive. Number 3 model is the most utilized model for my clientele. And again, talked about introducing the more increased bond exposure because you can make money in bonds already. The treasuries, you talked about that. Just a small re-entry into small caps, just because they've been beaten up for so long. So we took a small 1% increase and 1% initiation to that, international as well, just to balance things out because there will be certain parts of the foreign markets that will be okay. And then in addition, military defense. So yes, I know on the budget cuts they talk about what to do, what have you, but still with what's going on in the world and China, Russia, Iran, what have you, there's still going to be a place to be for military and spending. So you'll see a new fund introduced there. You will be the proud owner of silver and gold. So again, a safe haven just to ride it out for a few months there, and natural gas as well. So natural gas. I follow that daily. Again, hit a high. It was in the 3 range early January 2022. $3 or so to cubic costs per cubic foot. Went to 9.84 late last fall. Started this year around 3. Went down around 2. It's in the 2 range. It's on the low end of the risk range. So I anticipate a double for that between now. This is just going to be a short-term thematic sector play is what I'm doing with these. So in and out on that, but I do anticipate natural gas to be higher between now and the end of the year. And the same thing with gold and silver as things get a little more dicier. So that is just a brief little what I've done for my clientele. So I know Andy, Eric, Russ as well. So, and Jim, he runs his too. So yes, we've all talked, communicated, shared ideas, things of that nature. But, you know, we have a little bit of a defensive tilt. I more so than them, I guess. But, you know, it is what it is. And this is going to be maybe a 3 or 4 month, you know, holding pattern. And then I hopefully can get more aggressive. We all would love to get more aggressive in our models. Right now, there's just no reason to. There's a lot of canary in the coal mines and factors that are spiking their heads right now that are cautionary still. So with that said, I'm going to move on to some tips of the month. So tips of the month, there's a lot out there. So I went and talked about gold. So gold, this is just coming off of our visual capitalist charts that we use. So gold has hit 30 years central bank demand. It's the high. So right here is end of 2022 into 2023. So pretty much people have shifted from shying away from gold, central reserve banks, to now buying gold. So they have been purchasing gold hand over fist pretty much towards the end of last year and into this year as well. And it's primarily China and Russia, the two leading countries that are buying the most gold. So amid high inflation, geopolitical uncertainty, central banks bought a record 1.136 tons of gold in 2022. And again, like I said, emerging economies, including Russia, China, India, Turkey, account for the bulk of the gold purchases, primarily since 2010, but the most of it has occurred at the end of last year. And so people say, well, why are people buying gold? Basically, you buy that to balance out, to balance out the countries have been stockpiling gold to help hedge against financial and geopolitical risk affecting currencies, primarily the U.S. dollar. And so I just wanted to sort of point out why gold has been, on fire of late. So I don't anticipate holding it forever, but it is a place to hold in a portfolio for this time being. Other tips of the month. This came out as well. You got the email today, but this is a good blurb. I'd like to communicate as best we can. A mortgage recast is an alternative to refinancing. So we've mentioned, Andy and I and others have talked to you for years to refinance. Free money. It's below 3%, 30-year rates, what have you. Now it's over 6%. 6.25-ish, give or take. So, people are rate locked. They're not really moving. When you have 3%, 30-year fixed rate, why are you going to go, unless you have to go? So this is an alternative to this. So think of this as a way to, hey, if you want to reduce your monthly mortgage payment without having to refinance, you may want to explore the mortgage recast. It's basically you put extra money you may have inherited or you maybe got a bonus or a tax refund, something like that. You could put money towards the principal of your mortgage, of your current home loan. So then the mortgage lender is going to recalculate it. It's called reamortize your loan. And then basically you have a new lower balance, which reduces your monthly payment. Your interest rates, the number of years remaining on your loan stays the same. So again, it's just a way to lower your monthly payment. If good for people maybe nearing retirement, like I said, if you bought a smaller house, instead of getting like a bridge loan or what have you, you do that. But in addition, you're building a house smaller, you get the bridge loan, you go you sell your house, but then take that principal, put it down on the new home, ask the lender, obviously, if they do allow recasting of the mortgage. Not all lenders allow recasts, but it is an easier way. So recasting is generally simpler. It's less expensive than refinancing because you're keeping the same mortgage instead of applying for a new one. So it doesn't require extensive application, no credit check, no new appraisal, no closing costs, though you typically will need to pay a processing fee, but it's nominal. So the key is just check with your lender. That's an article that went out to all of our clients. So I just wanted to bring that to the forefront, highlight that. So recast is your alternative to refinancing. Another tips of the month, something different. This is from Neil Howe, one of our demographics from Hedgeye. This came out from 4/15 of 2023. How young adults, I was a big dairy drinker, so I had 2 to 3 bowls of cereal a day growing up. That's just how we lived on cereal growing up, my brother and I and family. So I try to get that into my girls as far as drinking dairy products as well. But American, it's just they're not drinking as much. So this is the lowest. It's fallen. It's been falling since 1940s, and basically, this is just a chart. I'll hold this up here, and Nathan, our producer, will zoom in a little bit. But it's just the dairy chart. It used to do 0.57 cups. It's a little bit more than a half a cup a day, down to 0.33. So it's just a slow descending amount of people. This is just pure drinking of milk. It doesn't include cereal and stuff like that. But I thought that was interesting how people are getting away from milk. I know obviously there's different types of soy milks and different brands and types of milks that are out there, but it just shows the overall trend of people not drinking milk as much. Just wanted to throw that out there. And also, don't want to, I hate being pessimistic, but this is just another came out from Neil Howe, Trend Spotting on 4/13. He's a demographer, so he's on the team from Hedgeye. But American pessimism is hitting new heights. Not only are people worried about the children's future, but they're also stressed about the immediate financial future in the situation. So American pessimism with long-term future has reached new and historic heights, according to the Wall Street Journal and the NORAC survey that they do yearly. 78% of adults don't feel confident that their children's lives will be better than their own. That's a rise of 11 percentage points since 2019, and that marks the highest reading ever recorded since this question was first asked in 1990. So there's just a visual for it. It's sad, but this shows you, since 1990, in the chart here, just going up. So it's the highest pessimistic that people are feeling about overall financial well-being and for the children's lives. They're going to be better off. So it's not good when you have 78% of adults not feeling comfortable. In addition, 44% say their finances are worse than what they expected at the current stage in their lives. So this is a graph. Again, 44% of people feel that they're in a worse off position financially than they thought they would be at this point in their life. So this is a study. 17% feel that they financials are in better conditions. Only 17% of the folks that were surveyed feel that they're in better condition. 39% are about what they expected, and unfortunately, 44% are worse off. So it's just the overall, the direction of where the economy, country, and where everything's going. So it doesn't surprise me, but I did want to point that out as far as things to consider. So with that said, hopefully you enjoyed some of those facts, and you know me, I love showing visuals. So let's go through the charts. So we're going to end on charts. Stock market volatility. Like I said, this is the lowest volatility of 2022. You can see that 17.1. Okay. So that's on as of April 14th. Actually, it's in the 16. Yesterday it crossed on the 16. So excuse me, 16 was yesterday's 16.9, I believe it was. So that's the lowest. And the volatility is the VIX of what the 30 days out in the forward guidance in the markets are going to be over the next 30 days for the options. So it's artificially low. It's like a balloon. You push it down, it's going to pop back up. The average VIX right now, going all the way back to 2020, it's 18.7. So again, periods of spikes up and down, but right now it's artificially low. So we anticipate a higher VIX. For the bond market now, instead of the equity market, it's called the MOVE index. So this is for the bond market. So right now, the bond market MOVE index is 119, again, as of April 14th, and the average is 84. So still elevated. It has come off recently over the past 2 weeks. It was closer in the 200 range. So you can see how dramatically it's come down, but it's still elevated. So we anticipate that. Again, the bond market typically is a leading indicator for the stock market. So, those things we watch closely. In addition, the S&P earnings, the S&P 500 earnings growth rate. So things are slowing down. That's what we're talking about. That's why we're in a quad 4. The historical average for the earnings per share is 7.8 average growth. This could be a negative earnings per share. Right now it is currently, but we just started into the earnings season. So it's negative now. The average is positive 7.8. We'll see where it ends. But again, 1.6 is the latest reading. So again, earnings are slowing, and we anticipate them getting worse during the second quarter, which is what we're in right now. This is really cool. So the bank, this is a new chart that was just put out. Clearnomics does a great job on this. So I'm on their calls as well. So FDIC bank failures. So FDIC bank failures, the number, let's go back to 2008 and 2009. So Nathan will hold this for a little bit. You add those together, 25 and 140. So that's 165, 165 bank failures. Okay. And you add it up together, 140. This is in billions, on the right, deposits in billions. So 140, and then, let's see, it's in the billions, 200, another 50. So let's call it maybe close to 250. So those 2 years together, 08 and 09, roughly $250 billion in bank deposits, in total deposits failed since 2001. How they've been tracking this. So those 2 years, 165 banks, over 250 or so $billion. Okay, let's jump forward to this month. Okay, so 2 banks have failed. So it's been artificially low. Not a lot of bank failures. Okay, artificially low. Only 2 banks have failed. SVP and the other one, First Bank. So with those 2, only 2. But look at the number in billions. About $260 billion in deposits. So 2 banks. That's how large those banks were. And versus 165 banks for less than what amount to 2 banks. It's an interesting chart. It's just, and no, we're not out of the woods quite yet. Yes, the big 4 banks, the cities, JPs, what have you, those are going to hold up. But it's the regionals and other banks that still have a lot. And again, let's go back to 2008. This next one, you go to the bank unrealized investment gain losses. This is also a new chart. So with this, it goes back to 2008, the Barney-Frank bill that was passed. So what was passed is they don't have to mark to market. So mark to market for banks means they have to show, like a mutual fund or a stock, 4 o'clock closing price. What is the price of the stock? Great. You know what it is. That went away in the Dodd-Frank bill of 2008. So when that went away and you had low rates, so you take a look at the axis here, on the y-axis, the low rates, they're flat, 0 to less than 1% for, let's call it a long time, pretty much. So pretty much low rates. But then what really, uncovered this is when the Fed started raising rates last year. So you see the blue line, which is the right axis. You see the rates going from pretty much 0 and going up, 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 up. So like 4.5%. So if you track that to the right, you can see the 5-year treasury on the right. That really hurt the banks and their net interest margin. And then you look at now the color on the bottom talks about deposits, unrealized gain or losses in billions of dollars. So let's look at the losses. So you can see over $600 billion in unrealized losses going back to third quarter of 2022 and into the fourth quarter as well. So when you add that up, second, third, fourth quarter last year and into this year, with rising interest rates and showing losses that are net unrealized losses, let's just call it the crap hit the fan. So that's what really led to all this. So they did not have to mark to market, meaning accountability on a closing basis. So it's unrealized losses that they carried on their books. And so hopefully that makes sense, adds a little clarity to it. But when you have bad policies, bad leadership, bad things happen. When you have money supply, M2 money supply, printing money for all these years, low rates, artificially low for 10 plus years. And then when the tide pulls out, you get to see who's floating naked there, and it's not pretty. So that's that. Fed hike cycles, hike cycles, The second one in, it's a current cycle. So it's the second most fastest rate increases, again, since 1980. So again, you'll see another rate hike next month, and it shows about the duration. So we're 400 days into this. So we're just starting it. We call it like a rounding second base is where we're at, if you want to put a baseball analogy. So that's why we're not out of the woods, still in the quad 4. Stock market, bull market, bear market cycles. So you can see the bull bear market. So with that said, the bear market is 1 year, 3 months into it right now. This is as of April 14th. So it's a rolling bear market is what we're into right now. So just keep that in mind. Luckily, bull markets, when they do come, they do last. They last a lot longer. Bulls last 5 years, 9 months. Okay, so that's the positive once we get through this. 2-year, 10-year, 2-year minus recessions area. So you can see the 2-10-year spread. It's hard to see the recession line, but we're in it right now. It's not officially, they haven't officially called it yet, but when they rewrite the history here, you'll see it. The spread was almost, was 1% inverted. Now it's 0.56. And that just means the 2 years providing higher yield than the 10-year. So why would you go out and hold a 10-year? So it's an inversion of the yield curve. And, they all lead to a recession. And this one probably will lead to an official one as well. Yield curve and the LEIs. So the yield curve, again, is on the right axis. So the yield curve, you can see as minus point, it's similar to the chart I just showed you, the point minus 0.56. And the LEI is leading in economic indicators. So leading economic indicators, that's on the left axis. You can see how it turned negative, so we're in the pink. So again, you can see the recessionary lines as well. So just showing both of them together, it's pretty powerful. So that's why I wanted to share with you that. Leading economic indicators, again, stripping it out, going back, it's minus 6.5. So again, just not good. Economic activity indices. So non-manufacturing is turning down to 51. Anything ISM above 50 is great. But right now you can see manufacturing part of it's down to 46.3. So that's curled over as well. And this means we're in a contraction. So earnings are contracting, profit earnings recession. You're going to see all this uncover over these next 3 months in the second quarter and reveal itself. So that's why we all have a conservative stance still to the models. Unemployment, it's inverted. So you can see unemployment's on the left axis. So that rate's 3.5. Again, low unemployment, which is great, low unemployment. You can see how it's spiked up to well over 14. It's inverted to the left. And then the wage growth, that's on the right axis. Again, it's 5.1. So nice thing is, so it was low, low relatively speaking, 2% or so, spiked up to well over 8%, down to 7, and now it's down to 5.1. So you want wages to go higher, which is great, but it's not keeping up with inflation because inflation has been higher than that as well. So the real, the net, when it's all said and done, is people are just barely keeping their heads above water, if that. Consumer spending, again, retail sales, the average growth is 4.9. This is going back to 1995. So just retail, it's just a way that the economy, consumer spending have slowed and the economy slowed and people are reeling it in. So retail sales are now at 2.9. The average is 4.9. So you can sort of see that year over year. Consumer price index, again, CPI was well over 9% late last year. So now the headline CPI is down to 5. So 9 down to 5. Rates come down. We knew that rate of change. That's a given. But the core is still up, 5.6. So the core is now higher than the regular CPI. So core excludes food and energy. So think about that. Core CPI excludes food and energy, and that's higher than the regular CPI. So it's crazy how the government tracks things. And the Fed, they really focus on is the PCE inflationary. So the PCE is what the Fed watches. And again, they track the core PCE, which is only 4.6 now. So it's still elevated. And they went that down to 2% as their target. So it's still elevated. It's up 4.6. It's still going to be sticky. That's why we've been saying all year it's going to be high, elevated, sticky for the rest of this year. Yes, coming down, but still higher than 2%. So again, the PCE excluding food and energy, that's the PCE has come down, from let's call it 8 down to 5, but the core is still at 4.6. So that's why we're focusing on the core because that's what the Fed focuses on, which doesn't make sense because it's food and energy and other things are what's costing and hurting people. Oil and the dollar. So we track this too. So the dollar you can see is on the left axis. Excuse me, that's oil. Oil's on the left. That's the blue line. So you can sort of see how the oil went to 120 late last year, early this year, and then it went back down to the high 65, 70 range. And right now it's around 81, 82. The dollar, it's inverted. You can see that on the right axis, the dollar going back to 2014, January 2014, the dollar is around $80. Let's call it like 83. And it went up to like 114 beginning of this year, $114. And now it's selling in right around 101. So the dollar is, still something we're watching. Mortgage rates, you can just sort of see mortgage rates around 6.3%. And that's the average since 2008. It's been 4.1. So you can see it relatively compared to 1990 average of 6, 2008 average of 4.1, and then the latest average right now for mortgage rates around 6.3. So I know that was a lot of charts, a little technical there, but it is visual share with you, and you can comprehend it more, and you can go back and hit pause, blow it up, and get on your screens there. Again, be sure you like us on the YouTube channel here. Hit the red subscribe button. Again, we're all continuing to monitor everything. You'll see tweaks in the portfolio for my clients here this week. Andy and Eric and Russ, they'll also have a conservative bent to it as well, but I expect changes slightly as well over the next few months. So we appreciate you. Reach out to us any further questions. Thank you very much, and stay well and enjoy the springtime. Take care.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.